Hello and welcome to Sustainability Reporting. Not only is this a trendy subject, not only is this an ethical subject, it is also a highly examinable subject. We're really not talking about sustainability itself so much as the reporting of sustainability. It's about the reporting of sustainability. We're about the communication of environmental ethics. We're about talking. We're about communicating. We're about reporting. That's the first thing. The second thing is that although what you're going to hear over the next few minutes is highly technical, really this technical background is to enable you to criticize practical reports. Most questions involve the examiner laying out a fairly rubbish report and you criticize it on the lack of its communication clarity and its lack of fitting with the two standards. Let's get into it. Sustainable development is development that meets the needs of the present without compromising the ability of the future generations to meet their own needs. Strangely, the IFRS standards on sustainability don't actually define sustainability. Sustainability reporting, we've done this already in the introduction. Sustainability reporting is the reporting of developments in sustainability. And we're doing a reporting examination, and therefore we're talking about the reporting, not so much the sustainability itself. Right, okay, so let's get into it. So where does the sustainability report live? It lives inside the management commentary. But of course, entities can report on sustainability anywhere they communicate. For example, in websites and indeed in meetings and indeed over the telephone. So sustainability reporting is largely about the sustainability report, but it's not just that, it's about broader communication as well. The International Sustainability Standards Board, the ISSB, which is a subsidiary board of the International Accounting Standards Board, the IASB, has issued two standards so far, and they are IFRS S1 and IFRS S2. Notice the one on climate is not on climate, it's not the management of climate, it's on the disclosure of climate-related issues. So they are reporting standards. So IFRS S1, so in particular we're looking for consistency from report to report so that commentators, shareholders, investors can look at competing entities and identify which have the better sustainability ethos, which has the better environmental ethics. Yeah, it's about consistency. And that phrase, short, medium and long term, is very useful in examination. You tend to have the opportunity to criticize entities because they're only looking short term. And here's the centerpiece of standard number 1. Governance, strategy, risk management, metrics and targets. So these are the 4 components that you must have to have a successful sustainability report. Governance first. So you describe who does what and how often. Strategy, how you go about addressing the risks, how you go about taking the opportunities. Risk management, you disclose the processes you used and you describe those risks and opportunities. And then metrics and targets. So you disclose what your targets are and how you measure them. And of course, how you performed against those targets. It's quite a mature sport already, sustainability reporting. And there were problems that were identified by the early adopters of the TCFD. And they're not big, but I want to point them out to you now. Change creates opportunity as well as risk. And it's an easy mark to say, look, they're just looking at the risks. And the other thing is, did you notice that the order was a bit mangled? In the list by the TCFD, they decide on their strategy before they've looked at their risks and opportunities, which is back to front, obviously. What you need to do is look at your risks and opportunities and then consider your strategy to address the risks and take the opportunities. So it's back to front. This is the order that's actually used out there to address IFRS S1. And you can see it flows much better. What we disclose in a A good proper sustainability report is GROSM. We disclose governance, risk and opportunities, strategy and metrics. The standard also talks about the conceptual foundations of sustainability reporting. So we haven't got anything new to learn. It's just the same 6 concepts that we know. There are 3 further concepts. And again, these aren't new. So materiality, so any sustainability information that could change their mind is relevant. Reporting entity, so it is the financial statements group entity that is producing the sustainability report. And then connected information is actually exactly the same concept as cohesion, but rather oddly in IFRS S1 it's called connected information. It's just saying that, you know, when you're talking about the cost of a certain strategy within your sustainability report, that agrees to the actual costs in the financial statements. So the strategy report, the chairman's review, all of that stuff should all be connected and cohesive. IFRS S2, climate related disclosures. Climate issues, particularly greenhouse gases, particularly carbon dioxide, the reporting of greenhouse gas emissions. So here's the GROSM, but now related to climate. It's identical, except we're now talking about climate reporting, except within IFRS S2, there are 4 particular things that I want to highlight to you. Within the governance section, it identifies that the governance of measuring greenhouse gases uses something called the Greenhouse Gas Protocol. Again, it's sitting outside of the IFRS S2, but it is a document, again, quite an old document, that says how to go about measuring greenhouse gases. When you're looking at risks and opportunities, you've got to consider transition risks and physical risks. Physical risks are to do with the weather, and then transition risks are the risks to do with the politics. So when talking about strategy, not just your own climate ethics, but also the climate ethics of your suppliers and your customers, the value chain, and metrics. When measuring your greenhouse gas emissions, you're required to measure them within scope 1, 2, 3, and also report on your performance within scope 1, 2, 3. This is quite an old document. It describes standardized methods to measure the amount of CO2 that you emit. What are transition risks? These are risks a company faces from the shift to a low carbon economy, arise from changes like new laws and regulations, so we need to assess carbon taxes and the like. There are technological changes like renewable energy replacing fossil fuels. And finally, market shifts, of course, very important thing. Customers preferring greener products, actually looking at the green ethics. So there are risks and opportunities because of transiting from high carbon to low carbon. And physical risks are kind of the obvious weather impact risks. You know, floods, storms and heat waves, rising sea levels, temperature increases. When you're thinking about strategy, you need to think about your suppliers and also your customers and not just yourself. And then here's the scope 1, 2, 3 thing I promised you I was going to teach you. Number 1 is us, specifically us. We emit these greenhouse gases. Indirect is one particular input. It is our energy suppliers' emissions. And the scope 3 really is everyone else to do with us. It gets very, very difficult. Which brings us to the final point I just want to summarise. IFRS S1 and IFRS S2 are standards that are intended for application within sustainability reports. Sustainability reports sit within management commentary. And management commentary is compulsory or not, depending upon the rules governing within that particular legislative environment, within that particular jurisdiction. And therefore it does change from entity to entity and indeed from country to country. When you go from the United States to Canada or United States to Mexico, you get different rules. And the reason I was particularly thinking about that in the context of scope 1, 2 and 3 is the application of this within Europe in particular is to allow slow disclosure on scope 3 levels. So as soon as possible, you should be doing scope 1 and scope 2, metrics, performance and targets, but scope 3 further down the line. So there is an understanding that it's very difficult to measure scope 3 greenhouse gas emissions, and therefore there is an extended period before you would be required to disclose in detail on scope 3. All right, which brings us full circle. Let's go back to the top. Sustainability reporting. What is the key thing? The key thing is the structure. When communicating on sustainability, there are 4 pillars. They are governance, risk and opportunities, strategy and metrics. My name is Martin Jones. That is my summary of sustainability reporting. I hope you found that useful.